There we are. He is one of our trusted partners when it comes to all things portfolio or economic or market advice and outlook and things like that. So really appreciate his time today. Felt like with everything going on, things kind of starting to get somewhat back to normal, and hopefully, I'll knock on wood that we can stay that way. I just felt like it might be relevant to talk about kind of where we've been, kind of what we've gone through in the past quarter, and then what to expect from not only this upcoming quarter, but ahead of that. Because like we've always said, you've got to be forward-looking, keep the long term in mind. So I guess with that, Jordan, would you mind kind of like summarizing a bit what we've seen maybe year to date or in the past quarter, and then just kind of like more of State Street's kind of broad outlook on the rest of the year and kind of the shorter to midterm maybe.
Sure. Well, everyone, thank you so much for having me on, especially for the fine folks at Brio. So the summary of the past quarter is we're opening up. We are slowly getting back to whatever the new normal is going to be. And it has been a roller coaster of emotions in the stock market and in markets generally, especially around the world. We've seen investors feel that inflation was going to be really hot, and now it's come back significantly. We've seen fears about interest rates going up and interest rates coming down pretty sharply, even in just the past few weeks. That's true with credit risk. The US dollar has been all over the place. Commodity prices have been very bouncy, going up and down with really severe volatility. Growth versus value has been a big back and forth between the big tech stocks and then the more what they call the reflation trades. Those are the small cap companies, the value companies, the cyclicals, the things that tend to have a lot of sensitivity to the economy and perceptions of the growth rate for where the economy is headed. So what we would say is that overall, if you've managed to fall asleep on 12/31/2020 and wake up today, you'd say, wow, what a great time in the markets. If you've been awake and drinking your coffee and looking at the markets every day, it's been stomach churning. It's been such a wild ride. So it's a great reminder of why we have financial advisors to help guide us through this process. Trying to manage your emotions in this market is the most important thing, because we all know fear and greed ultimately is what rules our emotional decision making, and that can sometimes override our logical decision making. So the biggest thing that we've been able to say is just keep an iron stomach. Try not to obsess about the news and the markets. That's a story for 2020, obsessing about the news. 2021 is about living your life. The big thing here is as long as you stay diversified, we think that this is a great time to be invested because we have unprecedented economic stimulus. Growth is as strong as we've seen in the past, 30 plus years. And that we think it's really a great time to be invested, just staying diversified so you can hold on and importantly not panic. And when people panic, they tend to sell, and that is almost always the wrong decision.
Awesome. And so you mentioned how turbulent things have been as of late, and it's a bit, not easy on the stomach. This week alone, we've seen Monday we were down, the Dow was down about 2%. And then yesterday we had a great recovery. Today we're on track for another nice day in the market. But a lot of that news Monday was attributed to the Delta variant. There's some concern about that. Internationally, we're seeing economies start to close down a bit more. We know that the uptick in cases in the US are statistically being caused by the Delta variant. What are your views on that and what we could expect from the markets and the economy as Delta still is a trouble that we're dealing with?
Sure, it's a great question. It's on everyone's mind. I think here it's helpful to have perspective from how a strategist thinks about the world rather than someone living and breathing just reading the news. The most important thing to remember is that about 70% of economic activity in the US happens in big cities. And that's pretty true across the world. It's going to vary usually between 60 to 80%. And that's a bit of a good news story. The reason is people in big cities here in America tend to be far more likely to be vaccinated than those who do not live in big cities. And so for that reason, it seems at this stage pretty unlikely we'll have any more lockdowns in the big cities where almost the vast majority of economic activity actually occurs. And the rural part of America, that's not as true. But rural America also tends to have a much smaller economy and economic impact versus the big cities. But most importantly, the rural areas from a cultural standpoint are very unlikely to lock down again. So what the markets tend to care about the most, and this is true for the economy as well, is will we lock down? In the big cities, the answer is you won't need to. In rural America, the answer is they won't do it anyway. And so from that perspective, the US looks like it's still on track, regardless of what's happening with COVID. Once you look overseas, it's a little bit more dicey because vaccination rates are a lot lower, even in countries that aren't opposed to vaccines, that are wealthy. Take Japan, for instance. You're seeing how much trouble they're having just getting their Olympics off the ground. There we're seeing that that's a very idiosyncratic problem. You have to be a licensed nurse or a doctor to administer the shots, whereas in the US, a firefighter can do it. And there they demanded that the Japanese citizens go through trials on the vaccines before they would roll them out, which just slowed down the implementation of vaccination progress. And every country seems to have their own little story like that when you're seeing why aren't they as vaccinated as the US or Canada or France or something of that nature. So what we would say is that the US remains dominant economically as a result because we have the good news on the vaccination front. The emerging markets, sort of the third world poorer countries, that's a tougher story. And there we're seeing really the human tragedy is awful in terms of the impact that it's having, especially in countries that are very dense and poor like India. But nevertheless, we are making the progress in the right direction. And for that reason, while we're keeping a close eye on COVID, we don't think this is a reason not to be invested at this point.
Awesome. And emerging market. And so I just wanted to touch on that because China's been in the news a lot lately. They're still considered an emerging market. What would you say to the government's kind of involvement in a lot of the companies in the private sector over there? What could we expect from that? How will it affect maybe international rates of return going forward?
Yeah, this one is an interesting one because we're seeing a replay of what happened in Russia about 15 years ago. So Xi Jinping, who's effectively the new emperor of China, I mean, that's how much power he has, and he has power for life at this point, unlike prior heads of state in China. He's consolidating his control over the private sector as he already has done on the public side. And as he controls more on the private sector, he's kind of tightening the noose around the necks of these big tech companies that have become so powerful within China. Alibaba, run by Jack Ma, or formerly, Tencent, run by Pony Ma, and the like. And what he's effectively doing is elevating China's national state interest above that of making profit, making these companies subservient to the state and its needs. So I'll give you an example of how that works. Right now, China is the biggest importer in the world of commodities. And as a result, it's been hit hard by the big increase in commodity prices, more than really any other country. This has caused what's called producer price inflation, which is just the inflation that businesses face, not consumers, to rise rapidly, even more than it has in the United States. But because the Chinese state's very firm belief that they don't want to disturb what they call social harmony, are not allowing those prices to be passed along to consumers. So consumer price inflation is actually very muted, especially compared to the US. But someone has to eat these big price increases. Chinese state has decided and decreed that it's going to be the companies that eat those big price increases, not consumers. So profit margins are getting squashed. So not only is China throwing the book at the big oligarchs to make sure that they know their place and that they are a step below Xi Jinping and the Communist Party, it's also that Chinese companies across the board are suffering under this mandate that they can't really raise prices. So what's happening is that Chinese stocks have really hit the skids relative to American stocks. They're actually down on a more of a year-to-date basis. So what we would say here is that this is kind of similar to what happened in Russia about 15 years ago. In Russia 15 years ago, Vladimir Putin decided to throw the book at the oligarchs that run the Russian economy. And he elevated Russia's national state interest above making profit, and Russian valuations, what we call price to earnings ratios, never recovered, not even close. And so I think what we're seeing now is investors are cluing in to that history lesson and saying, geez, maybe I want to have less exposure here. Not only that, the relationship between the US and China is really hitting the skids. And this is one of the few things that is really a uniting bipartisan feeling in America. Whether you're a Republican or Democrat, nobody likes the Chinese Communist Party. And so what's been a surprise for a lot of people in the market is that Joe Biden hasn't taken a softer stance versus China, whereas the expectation that he would compared to how Trump had his relationship with China. So, and that effective is people are starting to wonder, am I even going to be allowed to own these companies? Because increasingly it's becoming a hostile relationship. And at some point in time, an adversary gets deemed an enemy. So we seem to be moving in that direction. So what we're seeing is that increasingly people are realizing China, which is 30 to 40% of emerging markets, is really slowing down the market returns you can earn in stocks for those who invested in that part of their portfolio.
And do you ever see it, maybe not to that extent, but being a risk in the US, especially with like the larger FANG companies like Amazon, Alphabet, Facebook, government intervening in terms of calling them monopolies and breaking them apart? I mean, that's definitely been in the news recently. I think they're losing court cases. But what's the risk there?
So in America, we've had a shift in how antitrust philosophy works. It used to be that market concentration was the determinant of whether or not you were a monopoly or not, and therefore whether you should be broken up or not. That has shifted really since the 70s into more of a consumer welfare standard. And that is, are you being charged higher prices as a result of market concentration, not just how dominant are you in a specific industry or market. And so the question is, are we going to see that pendulum swing back from consumer welfare towards just absolute domination of the market? So there is that risk, but the problem is that the dynamics in the Supreme Court kind of argue against that. It's more of a conservative tilt. There's a 6-3 conservative versus liberal majority on the Supreme Court, and conservatives tend to have the view that consumer welfare is more important than just absolute industry dominance. So it's unclear there. What we do know is that both the Biden administration and conservatives in Congress both are of the feeling that big tech isn't good for America, but for different reasons. And regardless of your political bent, both of them are of the same mind that tech has gotten too dominant, too big, and it's helping to squash competition and the competitiveness of the US economy as a result. So there is real risk here. It's just not clear how it's going to shake out because of the dynamics within the Supreme Court. So we'll likely see the pendulum shift more towards just absolute dominance being the market test of monopoly power, but it's unclear yet whether that will be sufficient to overcome the Supreme Court's desire for stare decisis, which is let it stand.
Got it. And so with that, do we see prices starting to increase? Could that contribute to some of the inflation that I know we're not concerned about inflation going forward? I definitely want you to elaborate on that. But if these big tech companies, and given where the Supreme Court is, could that lead to increased prices in some of those goods?
This is a great question. So what's unique about industry concentration as it relates to the big tech companies is it's actually been more deflationary than anything else. What we've seen is that the big tech companies have used their market power to drive other companies out of the marketplace, but they're doing so by really keeping prices so low that it makes it hard for other companies to be competitive. Now, there are certain areas where this may be less true. So for instance, big cloud computing platforms, the most famous one being Amazon Web Services, those prices are actually relatively high. And that might be an example of an abusive monopoly power that's not helpful for the consumer welfare standard. So perhaps there's an example where big tech has a liability. But as a whole, tech has been more deflationary than inflationary. And so it's unclear exactly how this would shake up the dynamics if we were to take some of that deflationary tech force off the table, if we were to throw the book at them. Again, this is one of those open questions where strategists and economists are at loggerheads with very strong opinions in both directions.
Okay. And then so back to, I guess, American politics is the fun subject to always talk about, but it seems like, and we've been saying this for years now, everything is extremely polarized. That definitely kind of came true during the most recent election. And so we're coming up on some midterm elections. I know historically there's always volatility, within 100 days of either side of an election or presidential election. Does that kind of data hold true for midterms elections or non-presidential ones as well?
So this is a bit of a mix-up. It really comes down to the question of gridlock, because this is where markets are the most concerned. So if the feeling is that gridlock is the most likely outcome and that there's not going to be much change politically, that tends to be a very good outcome for the markets, because the markets then have less political risk to try to price into what's going to happen. So as it relates to what's happening now, the view of the Wall Street community is that Joe Biden's ability to pass through major new fiscal stimulus, whether it's this infrastructure plan or whatever, is souring as he's losing momentum, as the Republicans have been pretty tough on him in terms of negotiating anything that has to do with bipartisanship. And that's just politics. I mean, if the tables are turned, it'd probably be the same thing as well. So the question is, will the Democrats be able to hold on to the House and to the Senate or both during the midterms? Historically, the answer is not great, but Joe Biden has an advantage. The advantage is the economy is strong. And as James Carville said back in the mid-90s, it's about the economy, stupid. And he was right. So because we're moving in the right direction with the economy and people are tending to get more optimistic, although there's a strong bifurcation about that based upon political affiliation today in America, he may have a fighting chance. What it's going to really come down to is whether or not he's able to pass one of these infrastructure plans. Because the infrastructure plans are so popular amongst Americans as a whole, even some of the Republicans are a big fan of the policies underlying the big bill that Joe Biden wants to pass. If he's able to get that through Congress, he might have a fighting chance of holding on to the majority in either the House, the Senate, or both. So I think the next couple months here are going to be very telling about the path of the midterms going forward. If he is able to pass infrastructure plan, that means that you're likely to see inflation fears become higher because it would mean a lot more spending. And it would also probably elevate political risk because then Wall Street's not clear about what other big political things are going to change because laws will actually be passed between Congress and the president. So this is going to be a big deciding point. And if the Democrats can hold on, political risk goes up just because simply we don't know what the future looks like with what legislation will occur as a result.
And historically speaking, don't the markets react more favorably when there's kind of mixed parties in office or mixed control?
Yes,
okay.
That is absolutely true. Now, there are some exceptions when the market thinks that there's going to be lots more spending that results. That tends to boost nominal GDP. And nominal GDP, which is just taking into account real growth, the productivity and the growth in the labor force, plus inflation. When nominal GDP goes up, that's usually very good for revenue numbers for big public companies. So there is a bit of a trade-off. So we'll have to see how Wall Street judges what's ultimately able to get passed. It's not necessarily the case that a gridlocked Congress is going to be good for the market. It could be the case that it's not a bad thing in this scenario if the markets don't think that inflation is going to get hot as a result. That's going to be the big deciding factor.
Okay. And in your eyes and in State Street's eyes, why should investors not be too concerned about inflation for the time being? And then sure. I guess to piggyback on that, is what are some things that even because there's always uncertainty, we never know for sure what's going to happen. What are some ways, the best ways to combat inflation?
From a policy perspective or in a portfolio?
In portfolio and just kind of, I guess, maintaining long-term approaches for things and staying invested. Sure. What can we do to combat it best?
Sure. So let's walk through those ideas. So let's start on the portfolio side first, because that's probably the easiest thing to answer. Within a portfolio, some of the important things you can do is to have assets that do well in a higher inflation environment as a part of an overall diversified portfolio. So, for instance, what we tend to see are that small cap stocks, value stocks, and more cyclical sectors, things that do well when the economy is doing better, tend to do better in higher inflationary environments. And so those are an example of how you can have an offset to some of your inflation risk, because as inflation gets hotter, your exposure to energy companies or to metals and miners or to consumer discretionary, which retail stocks do well in a higher inflation environment, or even real estate. Real estate's something that we're seeing market leadership shift towards. Real estate benefits because rents tend to be highly correlated or associated with higher inflation. Inflation goes up, you can charge more rent. That means that you can make more money while your debt tends to become less expensive to pay back. And debt is a big component of real estate. And so what we tend to see is that in higher inflation environments, real estate does great. People may not realize this, real estate is about the same size as the US stock market. So US stocks are about $50 trillion in total market cap. US real estate, both commercial and residential, total up to almost 50 trillion as well. So we're starting to see market leadership shift towards real estate as inflation becomes more of a likelihood. Now, to your first question, what's the inflation outlook from State Street's viewpoint? We're not going back to where we were, and that's where the 2% inflation. Those days are probably behind us. The big reasons why is that the labor force is changing so rapidly. Baby boomers are now starting to retire en masse. And as they do, they take people away from the labor force. And as you have less supply of labor and growing demand, wages go higher. What we're also seeing is that there's less supply coming into the market from immigration, which has usually been a big source of low-wage labor into the US. And so as there's no political appetite for more immigration, that drives up wages for people who have less than a college education. And so the combination of these two leads to more spending power, but landlords recognize higher spending power as an opportunity to raise rents, right? The whole business of being a landlord is capturing as much of your tenant's paycheck as possible. That's the business model. So we should expect to see that the real estate boom is going to lead towards higher inflation outcomes, because if you take a look at how consumer price inflation is calculated, the biggest component by far is what's called shelter CPI. Basically, how much does it cost to live in your home on a rental basis, not on the asset price basis. And so as more money floods into, say, institutions buying single family homes, their incentive is to raise rents so that they can make a good return on their investment. So we should expect that rental prices will go up, and that will start to drive inflation higher. So does this mean 5% plus inflation? No, it means more like 3 to 4% inflation rather than the 2% we've seen in the past. That's not a bad thing for stocks, and that's really important to note. Going back to 1962, what we see is that so long as CPI stays below 4.5 to 5%, valuations on stocks can stay elevated. But once the inflation starts to get out of hand, that sort of scary inflation plus 5%, that's when you tend to see valuations come down. So we're still in a good place at 3 to 4% if we can maintain there.
All right, I have questions based on some things you said. So one, I'll circle back to real estate. You mentioned how hot it is for like institutions that are now buying it and becoming landlords. Obviously, everyone during COVID wanted more space. They were spending more time at home, so they have been buying bigger homes, spending money on their homes. It's wood supply is ridiculous. Contractor supply is it's hard to find one. What can we expect? Is that increased demand just going to keep leading to increased prices in real estate and single family homes and I guess multifamily homes as well?
Yes, that's the short answer. The problem we have is that supply cannot keep up with the increase in demand. So let me explain how this works. So this is more of a demographic issue than anything else. What we're seeing are that baby boomers and the silent generation aren't doing what their predecessors have done, which is sell their bigger homes and downgrade into something that's more manageable. They're deciding to age in place instead. So that's taking supply away from the market that would be there otherwise. The other side of it is the kids of the baby boomers, the millennials, the oldest of them are now almost 40. So they are of the age where it's time to get married, have kids, move out to the burbs with a white picket fence, 2 kids and a dog, the sort of the stereotype. And there's a lot of truth to that. They're sort of following the pattern of that their parents blazed for them. Problem is they're running into a market where there's not enough supply, where institutional investors are gobbling up seemingly everything they can put their dollars to work in, and where we have a shortage of construction labor to build new homes. And so, depending where you live, for instance, I grew up in the Southwest in Arizona. If you take a look at the statistics in the Southwest, if you are putting up drywall or if you are putting up roofs on homes, 70 to 80% of that labor comes from immigrants from Mexico. And all of a sudden we've shut the door. So where are you going to find people to do those jobs? You can't do those jobs off the street. You have to be trained and you have to have a willingness to do it. And that's where we're running into a problem. As Amazon has really effectively set the new federal minimum wage across America at about $15 an hour, because you can have that job with no skills and no training, as long as you've got a pretty pair of shoes to walk all day long. That means that the jobs that prior to this had paid 10 to anything less than $15 an hour, you're having a hard time filling. So a lot of subcontractors are having a hard time finding laborers willing to work for lower wages on those construction jobs, and you don't get paid a lot to put drywall in. So they're going to have to start raising wages in order to attract people to do it. But what we're seeing is that across America, for a lot of kids in high school, those jobs are no longer appealing. Just as in the prior generations, for instance, when I was in school 20 years ago, no one wanted to really go work on a farm, which, that's just the way the economy has evolved. And so we've got an issue here where there's lots more demand and the demand's not going away. But on the supply side, we have got to figure out a way to become more productive with building homes. Home building is one of the few industries in America that basically hasn't changed in 30 plus, 40 plus years. We're still building homes more or less the same way, the same source of technology. Productivity has not increased meaningfully when it comes to home building. So it makes it really difficult to automate these jobs because there's so much resistance to it. I mean, just think about it. How many different local building codes are there across America? Thousands. Makes it very difficult to scale. So we have got to have a national conversation about whether or not this makes sense. And perhaps we need to give more authority, take it away from the local governments and bring it back to state power, even at the federal level. Otherwise, we're going to face this problem of supply for a long time.
That's the first I've heard of those types of conversations, or at least needing to have that. Are those things happening right now in Congress? No. Not at all.
Congress is about as dysfunctional as it gets. So these big conversations we need to have aren't. Instead, we're too busy talking about what happened in the last election. And we need to be talking about what's going to happen in the future instead.
Gotcha. That makes sense. All right. And then back to earlier, you mentioned how wages for people under or who don't have a college degree or less, or maybe not even a high school degree. And you also mentioned how minimum wage is going up. So I'm assuming that I can make the assumption that people who may not have had as much disposable income several years ago are having it more than ever, maybe. And then on top of that, we're getting a lot of stimulus from the government, or at least we did over the past year and a half or so. And I know there's talks of some more. That has led, or maybe is part of the reason it's led to more retail investing. At least we're seeing that, especially in like college age folks and even younger. I mean, Fidelity is now letting people under 18 invest in their teen accounts. What are the concerns, or I guess, what are the benefits of this happening from your point of view?
Well, there's a couple of things. One, it's great that people are investing more. People should be the best. It's like asking the question, what's the best time to plant a tree? Best time to plant a tree is 10 years ago. Second best time to plant a tree is today. So it's great to see that people are finally getting invested. What we've noticed is that millennials, up until really COVID, had been reticent to be invested to the same degree as their predecessors, the connectors, the baby boomers. So I think it's great news for America that more people are wanting to invest at a younger age. That's how you compound wealth for the long term. But there are some costs to that. Well, we see that younger investors have less experience, and so they tend to have what we call paper hands, which means that they get scared out of investments more easily, and they're more likely to panic sell because they don't have the same experience and they can't afford to pay for a financial advisor to help talk them off the ledge, so to speak. So what the net effect of that is driving up volatility and making the markets much more stomach churning for everyone else. And because the stock market is a leading indicator of where the economy is going, it's leading to a lot of confusion about where is this economy going? And it has a lot to do with investors driving up volatility. But there's also some other associated longer term benefits. Younger investors are willing to take chances that older investors might be scared from. So there is a strong embrace for innovation. And that's true in every which way you can define it. Whether it's in things that may or may not actually have real economic value, like cryptocurrencies, or willingness to invest in more speculative ventures like IPO companies with untested business models. All these are unlocking sort of let's call it lots of locked in companies that wanted to have access to the public markets. Now they have a willing investor base who are willing to take a chance on them. And so this is opening up the door for innovation to more rapidly infiltrate the US economy. And this is really good for the long term. What we're seeing is that COVID accelerates everything, right? That's been true across the board. And this is true in the investment world as well. With all this new money searching for a home, and central bankers are largely responsible for creating all this extra cash, is trying to find new ways to be invested. Younger investors are putting that into innovative ideas, things that enhance productivity. And as a result, we should expect that long-term US economic growth will rise. Similar to what happened in the dot-com. A lot of those companies were garbage, silly, and in hindsight, they look like idiots would have thought of these company business models. But a lot of really great things got invested as well, including the fiber optic network that led to the rise of what the internet is today. So I'm sure the same thing is happening right now. Some of these companies we're going to look back will be the next Cosmo or pets.com, but some of these companies are creating real value. I mean, Starlink, great example from Elon Musk. Retail investors love Elon Musk, as crazy as that guy can sometimes sound, but he's creating real value with something like Starlink, which is going to be beaming Wi-Fi across the world from small satellites to low Earth orbit. That's terrific news. I'm out in Kauai right now, where I've moved about a year ago, and there's lots of places on the island have no cell phone coverage. And you cannot get internet. This is going to unlock a lot of this island to be accessible for remote workers who can now log into their computers, where before no Wi-Fi equals no work. So there's a lot of really good things happening as a result of the retail investor becoming more passionate.
And not to mention the increased Wi-Fi. I mean, that's always a statistic that's run about like low-income areas not having internet, and that can lead to lack of education. So now we're going to get, hopefully, more from things like that, more of an educated country, which can only lead to good things down the road. So
absolutely,
those come to fruition. And then, so you mentioned a lot of new companies going public, similar to .com. We've seen the rise of the SPAC, which is Special Purpose Acquisition Company. Some very close.
You got it.
And there's more what the market calls unicorns now than ever before, which are billion-dollar valued companies. What is that going to be another bubble? Is there a risk there with all these SPACs and how easy it is to go public for some of these firms?
Well, maybe we have to take a step back, because really what I think we're seeing is something that's much larger than the question of SPACs, and it's the right question to ask. What we're seeing are that small businesses in America are increasingly finding themselves unable to compete. And the reason is that they tend to operate on thinner profit margins than their larger public brethren. And so when labor costs go up, they're not usually as willing or as able to increase their wages to attract workers and then to satisfy this big increase in demand that we've seen. But public companies are. But public companies are not the only ones. We're seeing that increasingly venture-backed companies, so venture capital being willing to invest and help scale small businesses rapidly, and then with the hope that they can take them public or sell them to another company, are helping to fill the void created by small businesses pulling back. And so it's hard to say without the benefit of hindsight whether or not this could be a bubble. You never know. And I'm sure a lot of these companies that are being brought forth into these new public markets are not going to make it, but a lot of them are. And so this is something that I do think is exciting, but you do have to be cautious, because the retail investor, again, tends to be younger, tends to be less experienced, and they tend to be willing to take chances that for older investors may not make a lot of sense with the benefit of all their experience. So I would say that that's a super high risk part of the market that you have to be very cautious with, but overall, it's a good thing for America, not a bad thing.
Okay. And then before we open it up for questions, I know we've been going for a little over 30 minutes, so I do want to give people a chance to ask questions. When we touched base last week, you were really excited about the credit markets. I think that was the one thing you'd requested that we make sure we talk about. So I thought we would kind of lean into that and hear a bit more about it.
All right, so you guys, I'm really, really excited. So let me just preface that, like, some people are excited about sports or whatever. Like, this is my passion. So if you think that like I'm a raving lunatic talking about credit, just understand that this is what gets my motor going. So credit, you have to understand it's something of a dark art for a lot of people. You talk about the credit markets and they're like, I don't even know what you're talking about in the first place. You know, like, is it credit cards? No, we're talking about the bond market. The bond market is how big companies raise lots of cash cheaply for whatever they need to do, to invest, to pay their workers. It doesn't matter. It's their option. What we're seeing is that credit is how we take all the money being created by our Federal Reserve, our central bank. Remember, that's what's quantitative easing, basically money printing. And it gets shunted into public companies via the bond market. So we call that credit. And so credit right now, people may not realize that the cost of credit is crashing. And that is very exciting. The way you want to look at this is for investment grade versus non-investment grade. Now, investment grade companies are all the ones that you can name off the top of your head. Coke, Nike, Microsoft, they borrow an investment grade, and those interest rates are not that much different than what the US government borrows at. But they are the minority of borrowers. Most companies, the vast majority, are non-investment grade, which means they're paying higher interest rates for their access to money. Well, here's the exciting news, is we call that non-investment grade junk. Junk yields are crashing. So they just hit all-time lows last week. They're down 40 basis points. That's almost 0.5% in 2 months. Think about it like a 30-year fixed rate mortgage. If 30-year fixed rate mortgages just hit an all-time low and fell almost 0.5% in 2 months, you'd be like, oh my gosh, everyone's going to go refinance, because why wouldn't you? Well, here's the thing. Corporate credit, those bonds, they're almost all callable, which is the fancy way of saying that it can be refinanced. So you should expect to see a ton of refinancing. Carnival Cruise Lines just announced that a bond that they issued back in April of 2020, which is towards the worst of COVID, they issued that at 11%. They're going to refinance that at 4%. So what this means is that the cost of borrowing for corporate America, especially the smaller companies, is falling off of a cliff. So what you should expect is a couple of things. One, profits will go up as financing costs come down, and that's very good for offsetting some of the potentially higher labor costs that we're facing. But importantly, if you're an investor, you're like, oh no, I'm going to get even lower yields on my bond portfolio. Well, I got news for you. You ever heard that old phrase? The beatings will continue until morale improves.
Oh dear.
Portfolio. But you're likely to be okay with that. And the reason you're going to be okay with it is default risk. The odds of you not getting paid back are similarly also plunging right now. What we're seeing is that the economy being so strong, it's really hard to default during a boom. You really have to screw something up because everything is going your direction. Revenues are up. You've got as much demand as you can possibly want to satisfy with your productive capacity. And so what we're seeing, let's take the junkiest part of the bond market. They call it senior loans. Doesn't matter what it is, just know that it tends to be very junky companies. Default rates there are 1.25% over the past 12 months. And at the end of this month, it's going to be less than half of that as old defaults from last year roll off. And so for investors, they're saying, listen, I'm getting paid less and less and less to invest in these bonds. But on the other hand, my odds of losing money in these are going down as well because the economy is so strong. So as a result, investors are likely to continue to flood the bond market with more money because the alternative is earning zero in your bank account. And so as a result of that, this is terrific news for the economy because it means more money is flowing into corporate America, just like all those stimulus checks from the government were flowing into individual citizens of the United States bank accounts. And that's likely to be very stimulative. And that's something that because it's credit and people tune out as soon as they hear the word credit, they don't appreciate how powerful that really is.
Well, we do now.
Yeah, hopefully we can all share that same enthusiasm for credit going forward.
It's just great news, guys. I mean, This is one of those things you've seen, you're like, oh my gosh. For someone who watches credit really closely, I'm wondering, like, why are other people talking about this?
Yeah. Well, thank you. And then, so I know we've got, let's see, about 12 or 13 people on the call with us here. Does anyone have any questions? Just want to open it up for either Jordan or myself. Be happy to answer anything with our time remaining.
So just unmute yourself, or you can put something through the chat and we can address it that way.
And also feel free, I'll go ahead and chat in here my email address. And if you have a question for myself or for Jordan, feel free to send something to that email and I'll be sure to get back to you. And thank you, Beth. And so I guess with that, I'll just kind of wrap things up, just kind of tying this all together. So I think it's important to note with any one of these calls that we do, we try to do them quarterly. There's always bad things you can look at, and there's always good things you can look at. And I think it's important to note that, that's been that way forever since the stock market was incepted in like the 20s. There's always going to be bad signs and good signs. Historically, if you have discipline and kind of have a good asset allocation based approach to investing, you're going to be fine. But there's also some financial planning that needs to be done. You always need to make sure you have proper cash reserves on hand. You just need to make sure you've modeled out when your goals are, what your time horizon are. So I hope that you take this call and some of the information that you've learned here to maybe one, tell a friend how excited about the credit market you are and other things, but also to encourage people to have planning, to get that done yourself if you're not doing it. It's really important, and hopefully we can work together to put together portfolios and a strategy that's going to help you for the next 80 years or whatever, and we can go through many of these types of calls together. But anyway, Jordan, is there anything that you wanted to make sure that we covered that we didn't talk about?
I would just say one thing. The most important thing you can know right now is that it's going to be a bumpy road. Anxiety is high. People are stressed out still. And so the best thing you can do is that if you get nervous, don't make emotional decisions. Call the people you work with at Brio. They are there for a reason, and make use of them. Again, what we know from the historical studies, the biggest mistakes you can make is to let your emotions make decisions for you. And when you get scared, that's the very first thing you want to do. You want to shoot first and then aim later. So be sure if you feel that coming up, call the people you work with at Brio. You do not want to make the classic investor mistake of letting their emotions dictate their financial decisions.
Yeah, that's a great. I think a lot of people don't realize how emotional and how behavioral money and financial advice is. And it's easy to just get caught up with, oh, I can't sleep at night. But let's talk it out before you make any action. I can show you plenty of charts as to why you shouldn't do it, and hopefully just be a soundboard for you. Sometimes people just need a vent and hear that things are going to be okay. But anyway, thank you again very much. Shoot me an email if you have any questions, and just special thank you to Jordan for excellent commentary.
Yes, your enthusiasm is palpable and contagious, and I'm going to go read up on credit right now.
I'd love to talk to you about it.
Well, thanks all again. If you have any follow-ups, reach out to hello@BrioFG or Michael@BrioFG.com, and we can also get information from Jordan for future calls if you have any particular items that you're interested in hearing more about. All right, well, thanks all. We appreciate your time as always. And
Thank you.
Just give us a ring. That's what we're here for.